as we speak, Andy. Your webinar is now streaming live on Facebook. Full screen. There we are. How you going, mate?
Mate, I'm doing well. How about you?
Good to see you. Good to see you for another Wine and Wisdom, mate. Haven't seen you for like 2 weeks for Wine and Wisdom. Hey, today I'm drinking Chardonnay.
You're drinking a Chardonnay today?
Chardonnay. I don't know who it is. I don't know. It is...
a Chardonnay on Friday.
Chardonnay on a Friday. Levantine Hill, Catherine's Paddock. And really nice. Lovely Chardonnay.
In Catherine's
I've had a couple of... took the team to Top Golf today. Had a couple of beers, so I didn't want to mix red and white together. So I thought I'd have a Chardonnay for our Wine and Wisdom tonight. But hey, mate, great to see you. Great to see you.
Good to see you, mate. Hopefully everyone's had a cracker week this week. We, as we're getting everyone online, I wouldn't mind doing a little bit of a shout out. I'm not going to lie, I've already had 1 or 2 of these already, and like Jace, I don't want to mix them, but I already have. We've had a bit of an espresso martini, so hopefully the crew are watching us in the background. But we had a birthday in our team. So we had our first birthday celebrations via Zoom for our team, which was for Selena. So happy birthday, Selena, who's out there and probably still having a few drinks with everybody who's left over. But
here's one for her as well, Andy.
Happy birthday!
Awesome. We've got a few of the team dialed in now. Yep.
Sorry, mate, I'll let you go.
No, mate, it's just cutting in and out a little bit. Hopefully my internet's good today. What about yours?
Mate, mine's up and down. And I spoke to the providers and they said, yeah.
So we don't care. We don't care. We've got your money and you've already signed a contract, so we don't care. Maybe we can talk about that one. Well, it's good. It's good to chat to you, mate. We haven't had a Wine and Wisdom for 2 weeks now, so there's a bunch to go through. I'm pretty pumped about having a bit of a yarn today. I know a few of the team are on dialed in. We got sort of a few people online. I'm watching on my phone here just to make sure we don't miss any of the questions. So if anyone's got any questions for today, make sure you guys chuck them in the chat. Happy to answer any questions. My data provider, Tim's online tonight. By the look of him, I just saw him pop up. Tim, good to see you, mate. And there's Timmy Boyle. He's the man who gets the best charts and data on the planet. And he's my secret provider. So, Tim, you're the man. Love your stuff. So, hey, listen, Andy, what's going on, mate? I got something to throw straight to you, which is this should be right up your alley in the world of the marketplace. But, man, you know, what's going on here? What's going on here, mate? S&P index hit all-time high. Like what? Like, tell me what's going on. This is crazy shit going on right now, isn't it? I mean, you know, at the end of the day, you know, I don't know. It doesn't make any sense to me, but Andy, you might be able to shed some light. There's some interesting things going on in the world of real estate, but mate, I thought I'd chuck this one over the fence to you to kick off the night tonight. But for those who are just dialed in, we've got a few people on board, and just a quick intro for those who are joining us for the first time. A few of the regulars here, so awesome to see you. You know, Jason, Allison, Justin. Thanks for joining us again. But for those who are dialing in for the first time, Andy and Jason here, respectively, from our field of expertise and experience, the world of the market, shares, finance, Andy, banking background, myself in the real estate game, both of us 20 years plus in our respective fields. Elena, glad you could make it. So today, on Fridays, we usually have a little yarn. We call it the Friday Wine and Wisdom. And Andy, I think, succinctly coined it often more wine than wisdom. But it's a chance for us to connect and debrief on the week as professionals in our field and share a little bit of insight. And for you guys maybe to join us and ask a few questions and see if we can't share a little bit of our expertise in our field for a Friday evening and a debrief on the week. So thanks. A couple of questions coming through from Jason and Luke, so we'll answer those in a minute, guys. But I just want to chuck this one to you, Andy. What's going on here, mate? How the hell is this going on? The highest, all-time high S&P 500 index. Can you shed any light, mate? For investors, this doesn't make any sense. There's no, where are you at with this one? What do you think?
Mate, I'm just going to see whether I can bring up some stats here just on the fly. The S&P 500. So basically what we're seeing here is the emergence of the giants, and the giants are driving the market. So what we need to do is we need to look separately at the US market. G'day, Jono. Good to see you there, mate. We need to look at the US market for what it is and the Australian market for what it is. And it's a great discussion point, actually, because let me throw another, because we're throwing grenades over the fence to see how we'll respond. If I throw one at you, Jace, and I say, what do you think the Australian share market's made up of? What do you think is the biggest player in the Australian share market as a group?
It'd have to be the banks and mining, wouldn't it? Banks and mining, or farming, agriculture, banks and farming. I don't know. Are they the three?
Yep. Yeah, well, between banks and mining, you've got well over 50% of the All Ordinaries Index as far as market capitalisation. What would you say if I threw the grenade over the fence and said, okay, well, talk to me about the US. What makes up the US equivalent? So we've got the ASX 200, which is the top 200 stocks in Australia, and we've just said it's mining and it's financials that make up over 50%.
Yeah.
If we were to go to the US and we were to say, well, it's the S&P 500 over there, what makes up the majority of that?
You'd have to say tech, right? Like tech would be the giants, like Tesla, Microsoft, Apple, Twitter, Facebook, you name it. Would that be it? Would they be the big kahunas? Because none of them in Australia, right? So, I mean, Would that be the
100% right?
Right. Yeah.
Mate, you're 100% right. And I'm going to bring up a couple of graphs. And Apple is been in the news. And I loved Apple. And a couple of weeks back, I said it on this show. I said Apple was nearing 2 trillion. And I said, if anybody wants to take a punt, not that I was giving advice at that point in time, but if anybody wanted to take a punt, just buy some Apple, because the market wants to see a $2 trillion cap stock. Right? So, and what I mean by that is that Apple has now breached the $2 trillion market cap, which is out of control. And yes, it had great earnings reports. And this is, actually, I'll just go across there. This is Apple. And you can see here, just at the end, you can just see at the end. Now, this is 1 year, right? So this is 1 year. So you can see where the actual damage was done from COVID, which was around about here somewhere, right? So that's what the damage of COVID did.
Is that Tesla or Apple, Andy?
Oh, sure. Sorry, Apple. Beg your pardon.
I was going to say I'm looking at a Tesla share there. Tesla's good too. I love Tesla. You know, it's an interesting thing.
Look at the difference between the two charts.
I like him. Yeah.
But look at the difference between the two charts. They could almost be brothers, couldn't they?
Yeah, I was going to say they look the same.
So this is what's basically happening in the US, and it's not. We call them large caps. They're now giant cap stocks. If I jump back to Apple, everyone wanted to see Apple reach the 2 trillion, and that is this little jump here. Right? As soon as it started, and I can't do it on my little screen here, but as soon as they started to talk about it hitting 2 trillion, that's exactly what it did. Is it jumped up 21% because the market wanted Apple to hit 2 trillion.
21%. That's mad, huh?
And that's just in a very, very limited time. So, and Tesla is driving it as well. So we've seen this many, many, many times before in markets. But to go back to your question, why is the S&P going berserk? The tech stocks are going bananas. And are they backed
Yeah.
by good financial data? They actually are. They're backed by really good investment returns. So they're all, every single one of the big players that you can think of, the Googles, the Amazons, the Facebooks, the Tesla, not less so Tesla, but are reporting, and Tesla is reporting good earnings growth, outstanding earnings growth, but not reflective of where it is in the market cap. Yeah. But they're outstanding results. So they're all in there together. But are they really representing that kind of value? My opinion on it is that I think that there's FOMO, mate. And FOMO kicks into markets when they've run a little bit too long, and now people are starting to go, oh, I think I might have missed the boat. I better get in quickly before the gravy train ends. Yeah, may keep on going. Who knows? But the reason why the S&P is there is because of the tech movement. If you stripped tech out of the S&P 500 if you stripped and the NASDAQ index, which is almost wholly performance based on tech, you would end up with returns that would be very, very similar to Australian market conditions, like really, really similar. And the reason why I drew that parallel about what's driving markets is, well, what's happening in mining and financials in Australia? Not a lot. Expectations of bad debt for the banks. Mining is starting to come back on in different areas, and there are segments of mining that are killing it right now. There really are.
Yeah, I mean, iron ores, it's all-time high prices, right? But is that reflected in the earnings?
But it's also not like a secular bull market as far as all mining's concerned. Like not everything's up.
Yeah.
So we've got the two largest sectors in the Australian market that are on a bit of a burn, but not a great burn. But we're seeing in Australia the polar opposite to the US. We're seeing companies like Ansell crushing it, condoms and rubber gloves, as I always say. We're seeing consumer staples crushing it, online selling. We're seeing all of these departments that potentially haven't been driving markets previously. We're seeing them driving them now, but all that's done to Australian markets has actually lifted them a little. In America, these giant caps have driven them, and that's my opinion, and it's fairly strong based on fact.
And they're growth stocks, Andy, right? Like, what is a dividend out of a stock like Apple or Tesla or one of those? Are you getting any dividends out of there, or are you buying for growth?
2% or less. They're growth stocks.
Yeah, right.
Australia is a unique market.
Is that right?
Most share markets in the world do not reward via way of earnings. They reward via way of growth. But a lot of countries in the world don't have capital gains tax, right? So you have to think about how you reward your investors, right? So if you're going to have capital gains all of the time, and maybe it's a chat for a little bit down the track, because I've got so much to say about the American election. It's a feast. I tell you what, we've seen so much change in legislation with COVID. I'm now willing to become a student again, put on my hat and just sift through pages of legislation, because the world is changing. And the legislation of tomorrow is not going to be superseded. It's just going to be added on to the world. The legislation of yesterday, there's going to be twice the amount.
Yeah. Well, mate, it's an interesting conversation. It's really, really, because I'm quite excited about, you and I have talked about it for a while, the opportunity of the next, I don't know, 3, 6, 12 months, if you're a smart investor, you get your money working well, certainly in the share market, 20% in a couple of weeks or something on Apple, that's insane. I mean, that stuff's crazy. You never see that in a real estate market, not in a million years. But consequently, the flip can happen. 20% can be in 2 weeks on the opposite side too. So you take the volatility and the up and the down with it. But
it's coming, mate. It's coming, and it might go up 20% before it hits. But there will be a price rationalization in the growth stocks, absolutely, at some point.
As you go, yeah. I mean that yield. We've got a few people sort of dialing in. Alison, Vivian saying hello, which is good. But listen, there's a couple of things that I wanted to sort of maybe touch on this week as well, or this Friday. We've got, Melbourne back in lockdown, and that's sort of starting to take its toll a little bit. a few things. So, a little bit in the media, which I'll sort of talk about, which for me, interesting. I was talking about this one before. Melbourne received the, largest supply of new office stock in almost 30 years. Most of them are vacant, and you and I talked about this, Andy. It was confirmed the other night. Well, not confirmed. I mean, confirmed is not the right word, but we had Dr. Andrew Wilson, an economist, in at Positive, and he had a bit of a chat with us. And he said exactly the same as you and I, Andy, were talking about the world of commercial, or the world of commercial industrial. It's a two-speed thing at the moment. Industrial, certainly warehouse, industrial, storage, the Amazon factories and those sorts of things, the pick and pack factories, it's going through the roof. That type of real estate is actually killing it right now. His call, which was quite interesting, Andy, was that he thinks the mega distribution centers aren't the thing to back. He's calling a little mini distribution centers spread throughout locations. So instead of, 10, 20,000 square meters of warehouse somewhere, because we want some speed of delivery, he's talking maybe there's some opportunity in some of these commercial spaces closer to cities to do smaller distribution centers, which is
I'd be interested to know whether he was shunning one in favor of the other, or he's saying there's going to be there's going to be good growth in the larger areas, but there's going to be exceptional growth in these smaller hubs, because that's what I've been talking about. I think personally, I think that the larger hubs, when they're robotic and because it's sub-logistical, right? And we're breaking logistics down into different categories. But if we talk about the future, which may be drones, and it may be, and this is where everyone's thinking right now, they're going, we don't know whether it's going to be air, whether it's going to be bicycle, whether it's going to be electric automotive car, but we need to be able to think and put this stuff in convenience of all of them. But in order to get stuff quick, you need to take it from a large logistical space to a small logistical hub to be able to distribute seemingly instantly. Because they do a huge amount of data analytics that show, and this stuff I love, mate. We've been doing a lot of regression analysis with some of our geeks in regards to, let's just say, Richmond in Victoria, right? Online across groups, if we wanted a logistical hub, they're actually analyzing the data of what is trending at what points in time, so that they could potentially store things ahead of time in order to preempt the demand, so it has almost that instantaneous delivery. And you think about trying to buy logistic areas in Richmond, like it will be crazy.
What's it going to be? I mean, that's it right now. You think about it, right? So, I'm an example. You're an example. How much stuff, for the first time ever in my entire life and in your life, how much have you purchased online in the last 3 to 4 months? And both, and I know the answer to that, because you and I have been playing around with endless amounts of toys, right? If I got the camera and I shone it around my little studio here, it's literally tens of thousands of pieces of equipment, and all purchased online. I've never purchased that way before, ever in my entire life, even though I'm quite comfortable with online purchasing. And one thing that COVID for the whole world has accelerated, I believe, is the comfort factor, and then the understanding of how easy it is to purchase stuff online. And also, talking to the picture on my screen right now, how easy it is to work from home. Today I caught up with my team. We played Top Golf in Queensland. There's a bit of a golfing thing that's kind of cool. But that's the first time physically we'd been together for, 2 or 3 months, maybe even more, as a team. And we were all cool. Like we've been interacting on Zoom like this. It is really interesting. And Vivian was just chatting out now. I'm sure Vivian saying her mum's shopping online too for the first time.
Wait, people. My mum's watching this, Vivian. So just that. All right. That.
Hopefully Andy's mum doesn't give us an angry face anymore. I promise. Well, I can't promise I won't swear. I can't promise I won't swear. Sorry, Mrs. Fenton. I do swear a bit. I don't mean to offend. But this is the future, right? And the longer this training, this institutionalization goes on, this behavior modification happens, what is the future for us all in this space? And what does that mean for the value, the underlying value? I love this stuff because I think the share market and the real estate market go together, right? What is the underlying thing that needs a distribution center? Amazon needs a warehouse. That has to be physically somewhere. So, if you can think of that combination of those two things, there's where the share market and the real estate market, fit together quite nicely, and those ideas. So, I'm pretty interested in understanding that as we go forward. You and I have talked about, combining the investment strategies of real estate and the share market in smart ways. I think it's clever to do so. As you build your equity, as you build your wealth, you diversify not only in locations in real estate, but also asset classes and capacity for liquidity, and especially in your sort of your older, and old is not the right word, when you are in the the backstretch of your investment process, mixing up your liquidity and your growth and your capacity, I think is quite smart. But listen, I think the commercial world of office real estate's got some problems and challenges that's showing up right now in the Australian real estate market. One thing that sort of popped up, Andy, this week in the world of real estate was vacancy rates, right? And vacancy rates. This is Melbourne CBD, and I talked about this morning in one of my chats. Vacancy rates in CBDs on the east coast of Australia, because specifically, but the other cities have got a little bit of it. But the vacancy rates have skyrocketed, absolutely skyrocketed, because of the style of real estate that's built in CBDs. Now, at Positive, we've never encouraged owners to invest in CBD real estate. It's the most volatile real estate market, or residential real estate market in Australia, and avoid it like the plague. You've disappeared, Andy. You're still there? Hopefully you are. And the idea that these markets, you need to make sure you manage and make sure you don't get your real estate in, are pretty important to understand. But the media, like I was saying this morning, gang, looks like Andy might have disappeared off the radar here, so I'll keep chatting until he shows back up. I was chatting this morning, and maybe a few of you guys were listening in too. CBDs are a pretty average place to invest in residential real estate, because they can be oversupplied pretty quickly. And as we can see in this chart, they are very easily, the vacancy rate can spike very easily, very quickly. So are you back, mate? What happened? You disappeared on me.
Mate, I had to switch routers because Optus, I'm now on, and hopefully the latency isn't too bad, but I'm now on NBN satellite. Well, that's what we've resorted to.
Fingers crossed, mate. Fingers crossed. Mate, you're looking good. You're looking handsome anyway.
Thank you.
But mate, I was talking about CBD vacancies in Melbourne and in Sydney have spiked. And the predominant reason for those two vacancy rates to spike has been because of student accommodation, Airbnb accommodation in those locations, and
here's the thing, Jason, and I think I've sort of learnt from you, and I don't profess to know anything about property, but I don't mind dropping a thought-provoking opinion with very little substance behind it. But from what I've sort of observed with some of the things that you've talked about and the stock that you've had is, and one of them that I've really, really loved is that it's the ability for you to have a lifestyle in the place. and you took me through with some of your lads up in Brisbane through a place where I can imagine actually if the shit hit the fan and I was confined, right, in COVID, which isn't the case in Brisbane, right? But if I was, would I want to live there? Like, could I actually spend a week in there? Could I spend longer periods of time? And you and I've had this conversation ad nauseum on the other end of the scale, whereby these shit boxes that have been built in South Bank that are, little wardrobe apartments have destroyed the property market in certain areas. But I think that it goes to the quality and that lifestyle perspective. It's like, can you live there? And would you live there? And now, if we got locked down, would you enjoy being in that space?
Well, it's an interesting one, Andy. And I remember many years ago, I've had a number of mentors over my life, and one of my early mentors in the real estate game told me that value in real estate is driven by the underlying zoning of a suburb. All right, the ability for that suburb to increase its density, and if the ability of that suburb to increase its density via zoning changes from the councils, actually devalues its capital growth often, right?
So let's break that down a little bit further. Like, what do you mean by that?
So for example, give me an example of a suburb in Melbourne that's kind of like, low density and nobody wants to have apartments there or townhouses there. I don't know.
Murdoch?
Wherever it is, all right? Once the suburb has all of the lots of land built, okay, it's got houses there, okay. There is no capacity to increase the stock in that area, the stock coming to market in that area, unless the underlying zoning of that land changes and increases the density and it makes the lots smaller. Okay.
So classic example is where I live, right? So I'm just outside of Mornington and I'm in a rural wedge where we're on 10 acres, but you go over the other side of the highway, which is 150 meters, and everything is quarter-acre blocks. So here you cannot subdivide at the moment. And so 10, 12 acres is the bare minimum. So that's the example. Across the highway, suburbia, here, semi-rural.
Yep. And then that gives it, if that restriction gives that piece of real estate some uniqueness, maybe says, a 10-acre lot is unique in that area, and there's only a set few of them, then that then by supply and demand curves, if lots more people want to live on 10 acres than not, the demand goes up and the supply is like fixed. And so the competition for the value or that property increases and the value increases, right? And you see it in different suburbs. So, and one of the issues and the kind of the reverse of that issue is in places like CBDs or, fringe locations around the cities, they're endlessly being rezoned and redensified. What can happen is that can mess with the values often of the real estate until that, densification just compresses and there's no more value in buying and amalgamating two properties into one and turning it into 30 apartments or 40 apartments or whatever. So there's some interesting sort of understanding about what's been developed and then.
We're actually thinking about it from two different sides of the cycle. And I wasn't understanding what you were talking about because, so you're talking about it from rezoning we're both talking about it from rezoning to greater population in that area and the demand for increased population in that area. But you're talking about already populated areas actually becoming more populated. And I'm sort of sitting here going, well, we're in a reasonably low populated area becoming semi-populated. So that was my gap there. I'm thinking farmland, and I think if I could subdivide this property into 4 blocks, then that'd be it. It's game over. But you're actually talking about that suburban rezoning into townhouses. So the grand house into multiple townhouses. Is that what I'm hearing?
Two ends of that spectrum, Andy. So we're looking at both ends of the scale, and both ends of the scale can carry value, and both ends of the scale can devalue as well. And this was one of the realizations for me in the world of real estate was, if it's capable of over zoning and over producing real estate, it can actually hold the value of real estate at a set price for a very long time. Now, let me give you an example, because this is a classic example. So if you go to Melbourne's a classic example. So if you go back 20 years, the average size of an apartment, 2-bedroom apartment in Melbourne was 90 square meters. Okay, 90 square meters. And what's happened is the value hasn't increased that much, but the size has decreased significantly. Now, an average, which is pretty shit, a shit apartment in Melbourne, two-bedroom apartment is like 67 square meters. Now, the price hasn't gone up that much, but per square meter, the price has gone from 3,000 a square meter to 11,000 a square meter. Okay. So you got to think of it in those terms. For example, in Queensland,
11,000 a square meter. Mate, from what I know about when I was living in New York, 12,000 a square meter was the commercial going rate for Tiffany's in Times Square. This was a number of years ago,
mate. Yeah, good buying right now in Melbourne is 9,000 a square meter, 8 to 9,000 square meter. That's really sharp buying. Shit buying is 10,000, 11,000 a square meter, especially if it's very small. And that's not a grand statement, but if you're buying a 65 square meter apartment and it's in double digit thousands of square meter, mate, it's ludicrous. And you go now and you have a look at, it's interesting. You go have a look at Southeast Queensland's a classic example of this over the last 5 years. 5 years ago, the average size of a house on land block was 550 square meters. Right now, the average size of a block of land is 305 square meters. All right. Now the price, the cost of a block has gone from 160 to 220 or something like that. So you think, that hasn't risen much in 5 years, but per square meter, it's fucking insane. It's literally tripled in value per square meter because the size has decreased and the value actually has gone up. So when you think about it in those terms, it makes sense. So it's really interesting in the world of real estate. You got to have a look at the size of the property and you got to break it down into per square meter. And now what's happening, it's quite a challenging one now, is per square meter is not the only sort of metric, certainly in apartment space. What you were just saying a moment ago, it's the amenity that's attached to the building. So it's a per square meter and then the value of the amenity. Okay. The value of the amenity can literally add tens of thousands, if not sometimes $100,000 of value to the property, because you don't need a cinema, you don't need a dining room, you don't need a pool, you don't need a gym. It's all on the roof of your building. It's all there, and you'd pay more for it. So it's a really interesting thing. And I love the moving sands of this stuff because for me right now, I'm actually really excited about the next decade, Andy, because interest rates are so low. Real estate values can't be manipulated anymore by interest rate movements. They have to be manipulated by the quality of the property. And we've been talking about the quality. We've called it flight to quality for 10 years and no one's believed us.
Mate, and it's so true. It's when you hit zero ground, it's quality that comes out. And that's the same in business. Shit. And a quick shout out for the business owners watching. I've got some red hot tips at the end of this that we'll share it because I've got them pre-prepared. So if you're in small to medium business, please stay on. But that flight to quality that you're talking about is same in business as it is in real estate, as it is in share markets, cashed up, looking into the future. And so here's a couple of sayings that I've heard from people more recently. Last man standing. And I'm talking big industry. I'm talking agricultural machinery and things like that. Last man standing, small operating in distribution. In real estate, it's literally, well, now when there's the inflated markets and there's the FOMO is now starting to come down in real estate a little bit, where everyone's not going, let's just jump in because we're going to miss the boat. Then the sands settle a little bit and it goes, okay, what actually does represent fair value? Because when we call it in share market and in the stock market, we call it irrational exuberance. Just to put a term on it, which means you're a junkie and you're looking for the next high. But it distorts pragmatism. It distorts good choice. And sometimes, and this is where the quote from Buffett comes in, markets can remain irrational longer than you can remain solvent. But this is true.
It's totally true. Yeah.
But when you take out a variable, and let's be really fucking honest here, what's the variable? The variable is the government. The variable is the puppets, being the Federal Reserve and also, the Australian Mint, but their ability to then manipulate the economy stops from a monetary perspective. So you're 100% right. I didn't think about it from a real estate perspective, but now we actually get to see what is the consensus of value, what the people are really voting for, because we're not going to have the people jumping into stuff from FOMO. We're actually going to see what people really value.
Yeah, quality will stand up in these times. And listen, 13 years ago, what is it now? Actually not that long ago, is it? GFC, what's that? 11 years ago. 2009.
What year is it now? It's
220.
Yeah, 12, because it started late
2008.
Yeah, 2007. And
so call it 11, 13 years ago, gang. Unfortunately, I learned some lessons pretty harshly in those times about the quality of my real estate. And I can tell you, I had a pretty significant portfolio then in the, many. It was over 40 pieces of real estate owned personally. They were my pieces of investment. And I got squeezed. I'd over leveraged. I'd bought a few development sites that unfortunately the lender I was with got called in by the CBA, and I owed many, many millions of dollars upside down in some of the lending. And the lenders called me in. They called my commercial loans in, my development loans in at that point in time. And I can tell you right now, when I went, oh yeah, no problem, I'll just sell a few of my bits of real estate, because I wasn't as adamant about the quality of my purchases, 15 years ago as I am today. The only pieces of real estate I could sell were my fucking good ones. Excuse the French, Mrs. Fenton. But the only ones I could sell were my good ones. And I had to sell a bunch, like a lot of my portfolio, over 50% of my portfolio, to take care of things. And those properties today, I was left with the rubbish. I was left with the crap properties that no one wanted to buy in shitty times. And I can tell you right now, like that's when myself and Sam, my business partner, went, dude, the quality ones sell no matter what the time. Like right now, quality properties, whether it's COVID or not, people are still buying them. My team in Brisbane right now have sold record properties with views of the Brisbane River to retirees coming from Melbourne, like in the middle of COVID, record sales. Like they don't care it's COVID and Bob doesn't have a job anymore at the cafe. They've got $4 million that they sold their home in Toorak for, and they're moving to Brisbane because they want to live in the sun. You know, they're paying whatever. They don't really give a rat's
Come on,
ass.
mate. We know the reason why
There's
they're
no
going
sun
there.
down there, Andy, in Brisbane.
They're not going there for the sun, mate. They're going there to get away from the virus.
Actually, that's a bit of a backdoor. Actually, if you buy a property in Queensland, you can move. But you know, the point is, I learned a bit of a harsh lesson in that thing, you know, back then. So you know, the quality of your properties, don't underestimate them. Yeah, like they actually don't reward you today. Yeah, they don't reward you in the good times, the quality properties, but they reward you in the tough times. They're the ones that stand the test of time.
Mate, I got a great example of that, but after this, I want to quiz you on a question that some clients and a lot of business owners are asking. But just to mirror what you said, and just to make up for Margot Fenton, who's on probably listening as well, to make up for all the swearing, we can throw a little bit of one to her hubby, Tony Fenton, and talking about GFC, talking about quality of real estate. Now, I'm not in Resi, and neither was Tony, but do you know what was the one asset that actually saved majority of Tony's clients in the middle of the GFC? It's property. And here's the thing. So I'll mirror what you said, but I'll add a couple of extra things. And I'm talking commercial property. While everyone was jumping out of property, they were jumping in, but they were jumping into incredibly good quality real estate. So just near the Brisbane River, brand new complex, 15-year lease agreements with a semi-state run energy business. So it was semi-government organisation.
That works.
So when you're talking about quality comes in a lot of different ways. It comes in from my perspective, the real estate. It comes into the tenancy and the tenants, and the backing of those people that then you have in there as well. And sometimes when everybody is ducking, that's when you should be weaving and kind of going against the grain and kind of going, well, let's question this, because just because everyone's running, let's look for the opportunity in here. And I venture to say, and I know nothing about Resi really, but I venture to say, when and if there is a point in time where there is a flood, because it might be, as you said, these packy properties or wherever, and I mean the zone, not the race, but where these areas of low value real estate that people start flooding out of, it's probably going to have an overall effect, right? Because people start to develop a negative mindset against it. So it'd be really good to understand what that looks like, to have the positive tilt on that, because we're sheep, we're herd. So we will get out, and some people will get out of quality at a time when really all you should be looking at is getting out of the stuff that you don't want to be in. Does that make sense?
100%. Well, I mean, it's really interesting. And, you know, my business partner, Sammy Sagas, we've been business partners for 18 years. You know, he has a really interesting spin on this stuff. It's like, listen, the property is important for sure, but it's about the property's ability to attract a quality tenant, right?
Yes.
And you just mentioned that before, right? Like, you know, and this is not judgmental, this is just factual. If your property is in an area that attracts a tenant who has financial problems, how are you going to expect your wealth to be created from a property that has a tenant that has a financial problem? Like, they're no hopers, they don't have any ability to pay more rent, they don't have ability to pay more value for the property. It's in a secondary or third rate location demographically. There's no infrastructure. The jobs are crap. Like, you know, I see this all the time. It's an absolute flaw and a mistake for investors to purchase in an area that's cheap and has a high rental yield. By and large, that's an indicator often of a poor tenancy quality, right? And so, you know, it's a really interesting concept to kind of get your head around. And there's no easy kind of, this is the perfect way to do it when you look at that. But you think about it, like, what is the economic quality of the tenant that you are going to attract to that property? You know, its location, its design, you know, its amenity, you know, and that's what's going to dictate the value of your wealth of that piece of real estate. You know, like you're talking about the warehouse. You know, can Amazon be there, or is it just is it a 2-bit company that's struggling to get by? If it's a 2-bit company that's struggling to get by, that property is going to struggle with value, right? Or does it attract? Is that quality warehouse going to attract a government tenant who's happy to take a 15-year lease? You tell me.
And then it's the location that dictates who will take it over if somebody vacates it. Yeah, it makes sense.
Yeah.
I mean, there's majorly different fundamental drivers to commercial and residential real estate, but the basics seem to be reasonably aligned.
Yeah, I mean, there's a big picture, and then you got to drill down to the macro. But you know, it's an interesting concept, you know. So, mate, I love that. But
question, Jace, and so this is a hand grenade back over the other side of the fence.
Yeah, chuck them on over.
And it could be. Look, I'm not going to lie. I've been in this situation where I've been thinking right now, and I've had a lot of conversations with businesses that are going well, and kind of saying, well, you know what, Andy, what's the property play now? And I'm talking specifically now to business owners. Well, maybe not specifically. You guys can figure it out as you're listening. But this has kind of been going in the back of my head. COVID's coming through. There is going to be reduction of money supply into the system at some point in time over the next 12, 24 months. So there's some of us who are sort of sitting there going, well, do we buy in Brizzy or do we buy on the Tweed Heads because we want a holiday there? Because, and here's the thing, which we've never thought about before, we might struggle to get overseas for the next 2, 3, 4 years or whatever the case may be. So do we buy in the Gold Coast? Do we buy in the Tweed Heads? Do we buy in Byron Bay? Do we buy in these areas? Has that time already gone because of COVID and everyone is just trying to get north of the border? And it doesnndo matter which border you're a part of. Everyone is trying to get north of their border.
It's a knock-on effect.
It totally is. But do you know what I'm saying? There's a lot of these conversations that are starting to come up, and it's kind of like, well, Andy, do I buy a place in the Gold Coast and then rent it out, Airbnb it in the future and use it as a holiday home for the family? Like, what's your take on this? Because is this fad? Is this potentially the new normal? Is the price already being built into Queensland because of the population increase based on COVID? Like, I don't know because I'm not sitting there, but I'm getting asked a lot of these questions.
They're good questions. And part of building a property portfolio strategy is that, we call it that downsizer lifestyle move, right? I mean, you and I have chatted about this once or twice. Like, everybody, all of us right now, you, me, we're sitting in homes that once your children have left. Now this is predicated on an average person that I talk to who building a property portfolio. Usually, by and large, they're families and they have kids, right? So depending on the ages, or they're still living in their family home and their kids have just left, like whatever it looks like. But between the ages of kind of 25 and 55 or 60, that's kind of the demographic, right? So, but Andy, right, like everybody, you, me, no matter who we are, like I'm doing it right now. I've purchased a property in Brisbane, and the one, that Aria building. I purchased an Aria property, and in 10 years' time, I believe seriously that I will sell my home here, and I will live part-time in the Aria building in Brisbane and part-time on my farm in Byron Bay. Like that's what I believe. Now, that is a very, it's a cool move, right? Now, how do we structure that move?
Mate. I love that because you're thinking about the purpose. And this is why I talk about property with purpose. Are you going to own it to live in? Are you going to own it to sell it? Are you going to own it for income? Like, I don't do the resi stuff like you do, but there has to be a reason, because if there's no end game, it's just
No
by
end game,
luck
right?
that you get there.
Yeah.
But I love it. And just on that, because I've been asked this a couple of times, ballpark, and if you can't tell me off the top of your head, just give me a ballpark. What was the depreciation first year on that?
$25,000. Like,
or what was the percentage?
As it, 25 grand of depreciation that I can offset against my personal income. So I don't know about the percentage. It's probably 1.5%, as in, as an expense, as an add back on a cash flow. If you want to do it as an add back on a cash flow, it's going to 1 to 1.5%. AREA buildings are between 50 and 70% more depreciation than a regular building because of their quality, and you do not pay the extra money. That's one of the amazing things about those guys. But it
wasn't meant to be. I just wanted to know that because I got asked the question the other day, so it wasn't a promotional pitch, but it was a good one.
Well, I promote it, but really at the end of the day, how we purchase those properties, Andy, is a good question. And this is kind of like back in your court, right? So these are some of the conversations I've heard happen in the past. Let's say right now that purchase of the property in, for example, Byron Bay right now. Let's say a Byron Bay property, and let's say it's 700,000-800,000 right now, whatever it is, whatever it is. And you go, fuck, when I retire, I'd love to live there. I'd love to live 15, 20 years in Byron Bay, and maybe have another place that I live between Byron. Now, how can I buy it now? Because it ain't that great value right now, but then live in it later on. And you and I know that, not a bad move. A lot of people use their super in this way, potentially to purchase something and then transfer it later. Or, if they've got capable capital, they can do it another way. But there's a couple of ways to purchase a property, which is not necessarily a great investment move, but it's a great lifestyle move. And what you do is you exchange your home. Because remember this, everyone listening in, we all know this, right? Well, we should. Your home is capital gains tax free. So Andy, let's say in 15 or 20 years time, both you and I will probably say, shit, 10 acres, Andy, and 1 acre, Jason, is way too much for us. We don't really want to maintain this. This is bullshit, right?
I'll say, Jason, go down and I'll give you $10 to maintain my property down there once a year in Melbourne.
I'll come down and mow the lawn for you, Andy.
Right. But it does. It becomes it. And I've had this conversation with some of your clients and others as well recently, is that our expectations are very unrealistic about how we're going to end up. And the reality is that what we enjoy today is not necessarily what we're going to enjoy tomorrow. Right. And a lot of people are finding that out through COVID right now. But ultimately, you know what? There's no way I can't keep this place in when I'm probably 50. There's probably no way. I'm probably going to want to start to scale it back.
It's too much effort. Even Vivian was just shouting out now on the chat right now, 500 square meters of house is too much for her. Gang, think about this. Ladies and gentlemen, think about this. Let's be practical for a second. Most of us aspire in whatever we call retirement. I hate the word, but whenever you call, when you've got financial
freedom,
choice,
flexibility,
when you've got freedom and flexibility financially, gang, tell me, would you like to go on a 6-month trip around the world and just to have fun? Now, I can tell you right now, a house doesn't facilitate that. The friggin' grass grows. The gutters fill with leaves, right? Shit happens in that house. It's terrible. It's a terrible idea. But you tell me, you've got an apartment, you can walk out, lock that apartment up, and you can come back and it will be pristine. 6 months, 12 months, 2 years later. I can tell you right now, if you think practically about that concept into the future, living in an amazing apartment is going to be way better than living in a house. And think about that as the kind of the outcome, the destination, Andy. You know what I mean? It's you want some freedom. Freedom is not friggin' on Sunday going, shit, I got to mow the lawn, or shit, I got to pay for some bastard to mow the lawn. It's a terrible idea.
Right, absolutely. But we don't wrap our heads around this. But one of the things I actually loved, and we haven't spoken about this between us is if you have a lifestyle property, and the beauty about technology, and Airbnb is kind of shut down at the moment, but is going for listing at the moment as well. So Airbnb is about to list over in the in the US, which is interesting timing. But what was I going to say? Airbnb, yes, it gives us the ability to make a property that we can get substantial value out of ourselves. And it gives us the ability to be able to have that as an investment, a tax deductible investment, a capital improvement investment, and something that we can use moving forward.
Yeah. There's flexibility in there, Andy, and it's all about the strategy. And that's why, like, I love chatting with people. You know, I chatted with a couple the other day, and I just said, well, you know, you guys are middle 40s. You know, I want you to fast forward 10 or 15 years. Where do you want to be living? And they told me, we don't want to live where we are. Like, our kids are almost finished school. In 10 years' time, we want to be living in Burleigh Heads in the Gold Coast. Like, you know, and I said, well, you know, right now, if you wait 10 years to buy that Burleigh Heads property, I guarantee it's going to cost you $500,000 more. So why don't we buy it now? And why don't we think about how we can use it in the meantime, right? Dead right, Airbnb it. It's a great location for Airbnb. Think about the strategy in the meantime. Now, that can easily be woven into an individual strategy in a 10 or 15 year plan. And especially because here's the interesting thing, the correlation of where you want to end up living and where people go to holiday and enjoy themselves is often the same. It's Noosa, it's Burleigh, it's, I don't know, we're down in Melbourne, the Mornington Peninsula maybe, or like, where are those locations where people go, yeah, I'd retire there? It's often a holiday destination as well, right? So it's actually quite a nice correlation for a property owner in that sort of space. You know, it's really interesting.
I reckon we should do a long lunch or a wine and wisdom where we interview a few people, and maybe that's it. If you're listening, maybe we'll do this next week, where we'll interview a few people and just ask them about the different life stages. You're here now. Where do you want to be? And in 10 years, where do you want to be? And when you're with kids, where do you want to be? And when the kids are gone, where do you want to be? And then when you're done doing the lawns, where do you want to be? Because it's such a great conversation, especially when it comes to real estate, because we've done a couple with people recently whereby the acquisition of your dream home can sometimes be the investment for your retirement. Totally. Because it's capital gains tax free. And if you want the $1.5 million property and you jump into it, but you understand that the capital appreciation on that property is paying for what you're drawing down on your asset base over the next 10 years, but the downsizer is a part of the strategy, then and it's about the strategy, Andy. I mean, you and I talk about this all the time, you know. If you're listening in, whether you're a business owner, whether you're PAYG, you've got to have a strategy, gang. And it's a medium to long-term play. None of this is short-term. And, you know, if you want the good outcome, you've got to sort of put it in place and play to the game, play to the strategy. You know, business owners, I was chatting with a few business owners the other day, you know, and really at the end of the day, you know, for the business owners listening in, your own or occupy your own home, assets in a super fund. I mean, both you and I know you can, as a couple, you can have up to $3.2 million of assets in a super fund, income tax free and capital gains tax free at this point in time, right? Which is awesome. And also, Andy, one of the amazing things about a business owner, if you've been in business over 15 years, and there's a few other, you know, things to tick, you can sell your business for $2 million capital gains tax free as well. Like, I mean, you know, so think about stacking those gains together in one way, shape, or form. And a commercial property or industrial property can form part of your business value. So like, it's these strategies we got to like think about, you know, what are those strategies that are going to add value to you in your, you know, in your fun phase, in your choice phase, in your freedom phase of, you know, whatever it is in your world, you know. 100%. And the caveat then goes to possibly can have up to that amount. Just because I'm on the call, possibly as a business owner can have up to that amount, but you're 100% right. Now, promise the business owners, and so grateful for so many of you hanging on tonight. It's actually really cool to see everyone there. Just a quick one for the business owners. The only reason I'm re-mentioning this is I've seen so much of it recently, whereby businesses are not taking advantage of some very, very key fundamental opportunities. And this will go back to normal investors, so in a tick as well. So we're in the seasons of stimulus, and Jason and I will do more videos about the seasons of stimulus and more wine and wisdoms or long lunches as they may turn out to be. But what I want to bring, what has been the lesser taken, and this is for people who have not taken JobKeeper because they have either scaled their business to a certain level or are just for whatever reason not able to get JobKeeper. What I want you to do is I want you to have a look at this area here, because there's an alternative assets test, and there are a number of accountants and people who are onto this, but there is a massive, massive group that are not. So here's the thing. If you're on JobKeeper, you are generally eligible for the state-based grants, which tend to be about $10,000 tax-free, GST-free to your business per ABN business entity that is able to get JobKeeper. But here's the thing. So a lot of businesses have been scaling, right? And it's kind of like, well, it's based on GST revenue from last year to this year. And this one's been missed. People, this one has been missed. And I found a client today whose accountant missed it. Midway through the week, whose accountant missed it. And we're bringing it up. Have a look at this, because this could be $10, $20, $30, $100,000 worth of tax-free revenue to you. So have a look at this. We're going to post it in. It's called the alternative test. And this is for businesses where entities' turnover has substantially increased by 50% or more in the last 12 months, immediately before the application of the turnover test, 25% in 6 months, or 12% in 3 months. So what this does is this means that as a business where you have just really scaled and you probably brought more team into your business, right? So you're employing more people, but your profit has dropped as a result of it, but you've scaled. This is an application to the commissioner. I've now got 4 reports of people or of businesses in different states, 1 in South Australia, 2 in Victoria, 1 in New South Wales, clients of mine who have all been able to access it via this mechanism. And here's the thing. And this isn't shitbagging accountants. Please understand that if it was shitbagging accountants, I'd knock them straight between the eyes. But this isn't. Like, there is so much legislation, information dropping at the moment. It is not. Don't beat up. It's not a beat up your accountant day.
Yep. Hard to keep up. Yep.
Something that that we've noticed. Have a look at it, because here's the thing. If you qualify based on these amounts, that the intention of the program is to keep people employed and to keep good businesses buoyant so that they can employ more people in the future, right? So we've noticed that this has been a really, really big area. We'll drop it in the post in both Jason and mine, but check it out. Like, if you're a business that has scaled, but you haven't hit the JobKeeper because profits reduced because you've employed more people.
Yeah.
But if you look back over 12 months, you're less profitable now by 30%, but you've employed $200,000 worth of salaries, or even $10,000 more worth of salaries. You're eligible, right? You just have to submit the application. So
that's smart. You know, that encourages business to go for it, right? Because, you know, that's good. I love that. I'm going to be onto that too, because I mean, you know, for me and my business, like, we're scaling now, we're recruiting as we go, which is great, you know, because
they need to fertilize good business, and that's what that is. And JobKeeper is not to subsidize what they call now the zombie businesses, but this was, and Jace, this was from the beginning, and I missed it as well. I remember talking about it at a point in time, and I highlighted it, but we got so just inundated with everything else. But this is around and has been around.
Well, it's interesting, you know, Andy. you talk about this, the zombie business thing. It was really interesting to hear from Dr. Andrew Wilson the other night. And he brought a really interesting perspective, because I think, if, the time frame sort of gets a bit long in the tooth, and, Melbourne's second lockdown, and, everyone getting a bit sort of, a bit gloomy, bit Eeyore about the whole thing. Right. And basically he said, like, listen, gang, don't forget this. Nobody in this country, like not one single human in Australia or even in the world, wants this like slowness, depression, unemployment, COVID to last any longer than 1 second longer than we want it to. Like nobody does. Nobody's going to wait around 3 years to see how we go. It's bullshit. The moment people can get back to work, the moment businesses can go like, fuck, I'm on, the moment we can travel, the moment I can, go on a holiday, the moment that happens, boom, everyone will be back at it, right? And he said, don't miss that, because we're all kind of like, oh, we'll see how we go for a few years. That's bullshit. He said it's rubbish. Right now, if there's a vaccine tomorrow, and I'm not talking about the vaccine conspiracies, it's back on.
The vaccine that we had to have,
whatever that is, like, I'm not going there, and at the end of the day, Andy, it's not that hard to turn immigration back on. You just put people in isolation for 2 weeks. If the government wants to, it'll turn overseas immigration back on in a heartbeat. And it will happen, and what'll happen? There'll be hotels or temporary accommodation booms because the government has to host them, or those people have to pay for it. Think of that stuff. And it was actually really good shot in the arm. He's like, don't say, oh, 2023 will be okay. He said, no one's going to wait that long if we don't have to. The world won't. Everyone will have a crack. Whatever it looks like, he doesn't know. We don't know. You don't know. But Andy, if I said to you, dude, lockdown's over, you're not going to stay in your house for another week just to see how it goes. You're going to be out the fucking day lockdown is done. You're going to be watching the clock. 1 minute past, you're out. Okay. So he said, don't forget that, which was actually
for the
first
first time
in
4 years.
Which was good. Hey, Andy, I've got a bunch of questions here, which is really quite interesting. And I think what we might do is we might sort of spin these for next week, because they're interesting and it's really good. There's some good questions about finance, funding, other people's money. I got one here from David about talking about other people's money. I've got one here from I think it was Jason talking about, let's talk about lending for the future.
That's so interesting.
Yeah, it's interesting, right? Those sorts of things, other people's money. Andy, one thing that I reckon would be pretty cool, and maybe we'll put a pin in this for next week's Wine and Wisdom. Let's talk about money. Let's talk about lending. And we might be able to blow some people's socks off on this one. And we'll leave people hanging on. This is a good way to finish this, because Andy, better than anyone, because this is your neck of the woods. The world of private to public arbitrage of value, income from a private company to a public company is absolutely ludicrous, right? It's ludicrous. You and I sell our private company for 1.5 to 2 times something. And then public companies, I mean, you know this better than me, but for crying out loud, sometimes their value is based on 20, 40, 100 times more than a private company. It's ludicrous. And I would love you and I to sort of wax lyrical on this maybe next week and talk about lending and where money comes from. Because guys, somebody asked about, where does money come from, and securitized lending. We actually might terrify people, actually, Andy, just so everyone knows there's no such thing as money. It's just a dot on a screen.
And for those of you, that's where my finance journey began. It was in treasury operations, because I love debt. Debt is one of the most complex things and it's seemingly simple, but debt legitimately, since the Industrial Revolution, and even before that, right back to the Aztecs and the Incas, they were probably the first few tribes that didn't have debt associated with them. But certainly from the rise of the Roman Empire and beyond.
Lenders were there, bro, were they? Yeah.
And it is, it's incredible. It is versatile. It is nimble like a ninja. It's secret. People don't know about it. It is an incredible opportunity that people just don't even understand exists. It's the shadow ops. And then when it needs to be, it's the front page of the newspaper.
Yeah.
It's a really interesting
lending,
world.
Government's underwriting it, mate. You know, you and I could curl people's toes. So let's do that next week. If you guys are listening in and you want to be, you know, bring some wine for this one, because you don't want to take this one to heart, I can tell you, because if you really dive deep into this, you'll go and hide in a cave, I can tell you.
Bring some scotch. Bring some
you need some hard liquor for this one. Yeah. But it's a good topic. You know, yeah, it's a great topic, because you know what, and I'd love to sort of talk about this. You know, that mad Frenchman, I can't remember his name, who actually started the share market, right? The stock market. Basically, there is crazy Frenchman in, I can't remember the time. I was reading a book. It's a good book. I'll track it down. And basically, a mad Frenchman said, "Hey, listen, you know, a lot of rich people have got money, and sitting in a bank is actually not doing much for it. So why don't we create this platform?" And never called it a platform back then. Why don't we create this thing? Well, let's call it a share market, where lazy credits. It was called a credit back then. There it is. There he is. There's the mad Frenchman. There he is. That's the guy. He started the stock market. This guy
he looks a little bit like you, Jace.
Yeah. Well, if I no, I tell you, so like that stuff fascinates me. And you know, we're diving deep a little bit. You and I started a little bit early on our wine and wisdom today, and we're probably 5 or 6 drinks in rather than usually 1 or 2 drinks in. But you know, this mad Frenchman, gang, you know, just if you dive deep into the share market and debt, those two instruments, like crazy things, you know.
What my call is going to be here, Jason, we'll go back in 10 years' time from now and see whether this is true. But what I can tell you is debt will be as much a stock market type activity as what stocks are today. And debt is isolated, right? Because you can't participate in government bonds unless you got, you know, $100,000 or $1 million. You can't participate in private lending in Australia unless you are a sophisticated investor. So my question to you here, and fuck, I hope nobody from ASIC, and I'm not saying that you should participate, this is a big disclaimer, but the question I'd love to raise is, what makes you more capable to invest in a share on the Australian Stock Exchange, which is infinitely fucking complex? Balance sheets, forward cash flows, all of that stuff. How do you derive what the future value of that is?
Insider training, lying directors, bloody...
As opposed to lending that same money to a company. I don't understand the difference, but here's the thing. The share market was established.
Has a very simple legal framework, right? You know, Andy, you want some money? I'll lend it to you for this long, for this return. And if you don't, I can take this from you. Like, it's actually very simple. And I love it. Because you know what? I think the big disruptor, dude, is the whole world putting $5 all in a kitty and lending people money for their homes. Like, I think the variation in lending for someone's house is ludicrous. I think the banks owning that is flawed as a human right, personally. And for your own home, there should be access to some simple, basic standard fixed funding that every human on the planet has access to, and call it 4%, call it 5%, whatever you want to call it. Like, it just, every human on the planet is able to access the money and you can buy a home with it. End of fucking story.
But here's what happens from that, Jace. It turns it into an open market then, and it turns it into something which I love, because then everyone can play.
But but let's look at this, right? The blockchain could facilitate, the whole world could participate in helping that stuff. That's in my head. That I'd love to be able to facilitate that in the future. Anyway, we've had too many wines, I think, Andy.
Look, I've done analysis on this, and we've done hypotheticals in a constructed university environment around this. So I'll pose you the scenario. An up and coming block goes for sale. It could either have a 5-story Richmond in Victoria, 5-story unit complex. It could have 3 townhouses, or it could have a mega mansion built on it. It is it's an estate property, which means that it's going to be sold regardless. There are multiple different, so there are 3, but there are only 3 bidders for the property. One puts it into a high rise, one puts it into townhouse, and one wants to buy a mega mansion. And all of them are allowed funding from a universal platform that will give them the money based on the money that the people are willing to give them based on their idea.
Yes.
And their solvency and their ability to. So all of a sudden you look at lending,
which is all available for everyone to see already.
Total
like it's
transparency.
It's all transparency. Yep. 100%. Yep. And
so people bid to lend money into each
100%.
of those different frameworks, and only one is the successful bidder. The highest price wins. Everyone wins, because everyone is accepting the degree of risk that they want for the return that they think is capable. And here's the thing. So in this study, the income yield was the worst. It was the future capital growth of that property over time that actually won this hypothetical. So people were lending that money on a 2% per annum based on a performance fee of capital appreciation. So here's that. So that's, what did you say, Andrew? That's a loan. That's a loan of 2% per annum.
2%? Sign me up, Andy. Sign me up.
With a capital appreciation component to it. So what does that sound like? That sounds like something we've never heard before. In retail world, but it's out there. It's being beta tested by universities right about now, and we're about to go into another study with a different university doing these sorts of things. But this is on the horizon, and if there's ever a time where lending will change, this fundamentally, we're on the cusp of that. So I reckon it's a cracker topic. I love that. Debt is just freaking awesome.
Mate, yeah. I mean, Brian just chucked a chat in now. Peer-to-peer lending, Kickstarter, Indigo, peer-to-peer lending platforms. You name it. I mean, it is the future. End of story. And like something will be pioneered there. I mean, I was listening to a podcast from the guy from PayPal, right? And PayPal's acting for people around the world. People in not the first worlds, but in other locations, they're acting as banks. PayPal is acting as a bank for people who have a mobile phone, and that's their only access to internet currency. It's fucking amazing. And there's more people like that than in the developed world. So it's really interesting. I'm excited about this topic. Maybe it's 5, 10, 15 years before it's time, but it's coming.
Big can of worms, mate. When the major overhaul of banking legislation was? Actually, here you go. Here's the
Probably 1980 or something. Was it 1980 or it was probably a fucking gazillion years ago? Even further.
59. Banking Act of 1959. pretty
Hey,
sure
banks,
that's fucking it. It's
banks
been a
are
while since I've had to remember it myself.
Banks are dinosaurs. They're dinosaurs. Well, I got to chuck them a bone right now. They have helped Australians right now. So I'm not going to kick them while they're down, but when they get back up, I'll kick them. Still, they have given a lot of people some, mortgage breaks in the short term. It's the first time they've ever done anything for anyone, but they've done an all right favor for a lot of Australians in short term. But dude, the world is changing, and legislation needs to keep up. Banking needs to keep up. You and I don't want to be, like, it's bullshit that I can't lend you money and there's a platform for me to do that really simply and easily. Like, if I've got spare cash and I want to make some money and Andy's got an idea and I think it's good, there should be a platform that helps you and me meet on terms that we're okay with, and then that can't be changed. That is what's called the blockchain, is from what I understand. And the more people who understand,
that's an iteration of it. Yes.
Yeah. And the more people who understand about how to do an agreement on the blockchain, the closer we are going to get to that world which you're talking about, which is the best deal wins. People will say, I'm in for a deal, and looking for a return, and you choose the package.
People can play where they want to play, Jace. That's the thing. Like an open market. You know what? If I don't know shit about companies, because I've never run one, never seen one, never knew one, but I know a lot about real estate, well, I'll lend in that space. And And if I know nothing about property, but I've run heaps of companies and I know what a good company looks like, let me play in that space. I 100% agree. Oh, it's a great conversation. It really is.
All right, well, let's leave it there, mate. Been a good chat. It's been about an hour and a half tonight. We sort of caught up on my holiday. It wasn't yours, but it was my holiday last Friday. Thanks for everyone.
Just allow me to be host for a tick, mate. Can you jump on and allow me hostship, because I just want to show everybody something.
Yeah, totally, mate. Here we go. What do you go? Make host. There we go. There you go. You're the host now, mate. Go for it.
All right, let me see if I can.
While Andy's doing that, we'll have I reckon we'll circle around, gang, and we'll do something interesting for.
Now that's Jason on holidays, mate. I just want to know how your kite surfing, how your rock climbing was there, because it looked like you'd squilled some grips there. You'd done some amazing things. You'd sent us some incredible footage. Look at that mountain. Jeepers creepers. You were scaling it with a rope there. You were scaling it without a rope there. Jason, you're insane. But
crazy, mate. That's called the nose. Oh, that one is in France, that one right there. But the other one was called the nose. I've climbed that one. It's pretty cool, mate. I love that, mate. Good job with your good job with your video editing skills, buddy. That,
mate,
like a place, if anyone ever wants to visit an amazing place. I mean, if you live in Australia, gee, we have a boring country when it comes to geography. It's such a dull place when it comes to mountains, right? It's a lovely country. I mean, I love Australia, don't get me wrong, but the geography of Australia is dull as dog shit. When it comes to, in comparison to other places. So, I've been to America a fair few times, and climbing there is just mind blowing. Ignore Trump. The geography is amazing.
But each to their own, man. I love great winds and beautiful seas, and you love incredible mountains and great fjords. But maybe we can bring them back and represent the great countries and talk about the fiscal status and I don't know, stuff that's relevant. But mate, I love seeing you climb, because you're a bit of a beast, and it looks like you might have lost a little bit of muscle mass from when you were scaling that mountain. But either which, mate, it's always a pleasure to catch up with you on a Friday.
Mate, absolutely, brother. Good to chat with you. And thanks everyone for chiming in. There was a bunch of questions there, guys. Thanks very much. Gary, thanks for your question, mate. And Jace, thanks for your question. All of you guys, Brian, Emily, Tom, Graham, few questions there, gang. David, you guys, we're going to circle around to these questions next week. There was a bit of a
Christy, 100%.
Yeah.
We'll jump onto them next week. We'll stockpile them and jump onto them next week.
Absolutely. Awesome, gang. Well, everyone have a great weekend, and we'll catch you next week. All right. Adios, brother. Adios, everybody. Thanks,
Cheers,
man.
brother.
Bye-bye.
See you, everyone. Have a great weekend.